Bear market, just those two words alone will send a chill down any investor's spine. Today, I want to roll back the curtains and show you why they're not so threatening after all. On June 13th, we officially hit bear market territory. And for new investors, this unlocks a whole host of emotions, including fear, anxiety, and uncertainty. There are no guarantees in the stock market, but looking at historical returns and past bear markets, sometimes it can help alleviate some of these fears. In addition, a bear market is oftentimes a blessing in disguise for new investors. If you can take advantage of some of these opportunities, it can really supercharge your portfolio. If you're new here, my name is AC. I'm a full-time doctor and a lifelong finance enthusiast. My goal is to help you become more comfortable with your money. So without further ado, let's unravel the mysteries behind bear markets. Let's get into it. First of all, what exactly is a bear market? A bear market is defined when the market drops by at least 20%. In this current market, the top was defined when the SPY hit a level of 480 on January 4th. And the bear market officially started on June 13th when the SPY closed at 380. That represented approximately a 21% drop from the top. Since 1928, there actually have been 26 bear markets, which means that on average, you'll see a bear market every 3.6 years. The average length of a bear market is 289 days or approximately 9 months. And the average decline for a bear market is around 35%. At the time of recording this video, it's been approximately 290 days since January 4th. In addition, the SPY has dropped approximately 32-33%. That means we've hit the average length and drop of a bear market, but that doesn't mean it couldn't go lower. I don't mean to scare you. I just wanted to point out the obvious. These are all averages. Each market is very different, and so there's no guarantee what will happen next. On the flip side, I do have some good news. Every bear market to date has been followed by a bull market, and these bull markets on average last 3.8 years, and they've seen an average return of 112%. Last bear market before this one was COVID, in which the market hit a bottom on March 2020. For that bear market, it was followed by one of the strongest bull markets in history, where we had a 110% increase over a year. Overall, bear markets are inevitable. They're a normal part of any investing career. If you're a long-term investor over 30 to 40 years, you're probably gonna see at least a dozen bear markets over your lifetime. I still remember calling my friend on March 13th of 2020 and saying, I think I'm gonna sell a part of my portfolio. I think we're gonna go lower. A week later, we had an insane turnaround and one of the strongest bull markets in history. So it's suffice to say, no one can really time the market. So I wanna talk about the emotional side of investing next. Peter Lynch has a great quote. He said, everyone is a long-term investor until the market goes down. I think there's a lot of truth in that. Bear markets are often fueled by volatility, uncertainty, and negative news cycles. There's no wonder we're gonna feel poorly. And if we take a closer look, it's usually ambiguity that is driving most of our emotion. Our brains are a tricky thing. We usually hate ambiguity more than we hate a negative fact. So if we knew for a fact that the market would drop 60% and that would be it, we'd be okay with that. There's a couple of things we can do to combat our emotions. Number one, just remind yourself that you're a long-term investor. If you're invested in a Roth IRA or 401k and you're not over the age of 50, you really don't have anything to worry about right now. And that means stop checking your portfolio every single day. Now, I had a bad habit of checking weekly or even more frequently than that, and it would just spur these negative thoughts and emotions in my head. Nowadays, I don't really check my portfolio more than once or twice a year. It's usually just around the time when I have to make a contribution at the beginning of the year. In addition, I would try to tune out some of the negative financial news cycles. It's important to know what's going on in terms of the real estate market and interest rates because that can affect your day-to-day, but the rest, the stock market news and the drops and the news cycles, they're just not helping. In reality, they're just trying to make money by feeding off your negative emotions. So just tune it out. All right, so next up, what are some of the positive steps we can take to actually combat this bear market? There's a term known as dollar cost averaging. And pretty much this just means that you continue to invest the same amount regardless of what's happening in the market. So for example, if you're investing $1,000 at the beginning of the month and the market continues to drop, you'll get a cheaper and cheaper cost basis. So let's say that you're able to buy about 3 to 4 shares of SPY at $1,000. And if it drops any further, maybe you'll get 5 shares. And as you continue to buy, your cost basis will get cheaper and cheaper, and this will be the backbone of the recovery when the bull market finally reappears. Remember, the companies in the S&P 500 are solid companies with strong earnings and revenues. And this brings me to Warren Buffett's famous quote, be fearful when others are greedy and be greedy when others are fearful. It really boils down to two things. During a bear market, he knows that quality companies are on sale, and so he's greedy and trying to buy as much as possible. On the flip side, he knows during a bull market, things may be a little overextended, so he's not as eager to buy into those companies at those high prices. In addition to the stock market, there are other places where you can build your portfolio. You don't have to put all of your life savings into stocks. One of the best things you can do is actually start paying down your student loans. Now let's say you have student loans at 6% interest, which is what the federal government rate is. If you started to pay those down, you're guaranteeing a 6.5% return. In addition, there are high yield savings bonds. For example, the I bond right now is guaranteeing a return of 9.65%. I made a video on that as well, and so if you're interested, check that out. All right, and that's everything you need to know about bear markets. 1, bear markets are a normal part of any investor's career. 2, your emotions may get the best of you. It's your job to bring them under control. And number 3, dollar cost averaging may actually help you in the long run, and so you should just continue to invest. If you want to learn more about compound interest and why the S&P 500 is the only index fund you need to know, check out this other video. Anyways, I hope you gained some perspective about bear markets, and hopefully I was able to calm down some of your fears. I'll see you guys in the next one. Peace.